Yes, thank you. I'd like to ask about the external sector, starting with exchange rates and whether a falling Canadian dollar, perhaps continuing to fall, will um, exacerbate imported inflation. Conversely, whether that lower dollar will make a significant difference to our exports and improve our current account surplus, hence boosting GDP growth. And then to broaden out the question, whether dollar strength, that's to say US dollar strength, due to very high and aggressive tightening on the part of the Fed, might lead to forced tightening on the part of other countries, precipitating recessions around the world and dragging us all down with them.
Yes, so this is another important risk here. What is happening in the US economy and with the Federal Reserve. And this is one area where we'd be a little bit concerned as well, because there's a lot of evidence that, and when we look at this as forecasters, that the Canadian economy is more sensitive to interest rates. So it probably will start to slow down sooner and probably a little more abruptly. We're seeing it in real estate already. There is probably also the way the mechanics of inflation in Canada work. Inflation in Canada is going to cool sooner than it is in the US because of various technical factors, which I don't need to get into here. But inflation in Canada arguably is going to cool sooner. So that should, in theory, allow the Bank of Canada to back off from raising rates before the Fed. Now, the problem with that is every time the market starts to sense that, pulls down the Canadian dollar, which, as you mentioned, is inherently inflationary. And so our estimate, and I think the consensus view on this, the Bank of Canada has modeled this as well. I think roughly every 10% depreciation in the Canadian dollar versus the US dollar adds about half to 0.6 percentage points to Canadian inflation domestically here through the imported price channel, right? So at the end of the day, the Bank of Canada can't get too far behind the Federal Reserve with the inflation target in mind, even if certain sectors like real estate are slowing quite a bit more significantly than in the US. So that is an economic risk for sure that we have to over tighten simply because the Federal Reserve can't get the US inflation situation under control. I think we have to be mindful of that. To your other question on the trade side, I think yes, arguably there is some scope for a net positive outcome for net exports, but the currency effect might probably get overshadowed by the reality that the US is probably going through a pretty significant slowdown in demand as well. So the currency effect is incremental against just the overall lower level of trade activity. So it's not necessarily something that is going to buffer the downturn. It may make it feel a little less bad for a few sectors of the Canadian economy.
What is your implicit US Canadian dollar forecast for the end of the year or first quarter next year?
So right now, if we're looking at it on this basis, we're at around 73 cents in the market today. We have a little bit more weakness through the end of this year to around 72 cents. And then by the end of 2023, 75 cents. So we think we think peak US dollar strength is probably coming around the first quarter of next year. And that is more or less consistent with when we think the Fed is going to reach its terminal rate, and the market's going to start to eventually price in rate cuts in the US further down the road.